Welcome to Smart Finance Talks.
We're the place where we unpack the sources you're interested in, getting straight to the core insights, helping you get informed efficiently.
Exactly. No fluff, just the essentials.
To really understand the story behind a massive financial crisis.
Yeah, we're looking at how this, kind of obscure market suddenly blew up into something global.
It's quite a journey. We'll explore how it all started, who saw the cracks forming early on, and honestly, the surprising human stories behind all the complex finance stuff. Get ready for some twists.
Definitely. It's about the why as much as the what. How did this market even happen? Who were the key players noticing the problems? And what can we, learn from it all today?
Okay, let's get into it. The story kicks off maybe a decade or so before the big crash, right? With the beginning of the subprime mortgage market.
That's right. And interestingly, it didn't start out as this super risky thing. Initially, the focus was on lending to people with, pretty decent credit.
But that shifted. The demand for debt just kept growing, and lenders started moving down the credit ladder.
Precisely. They expanded into lending to borrowers with lower credit scores, the subprime segment, and that's when things started getting much riskier.
And the bonds they created from these mortgages, they weren't your standard corporate bonds, were they? The source makes that clear.
No, not at all. A normal bond is like an IOU from a company, but a mortgage bond bundles cash flows from thousands of individual home loans.
So way more moving parts, more complex.
Absolutely. And that complexity, especially the fact homeowners could prepay their mortgages, made investors a bit wary at first.
Yeah, that prepayment risk. If rates dropped, people refinance, pay off early, and the investor gets their money back sooner than expected, maybe at a worse time to reinvest.
Exactly, that uncertainty. So Wall Street, specifically Salomon Brothers, needed a way to make these mortgage securities more palatable.
Enter the tranches. The source has that great analogy, like a building flooding.
Yeah, that's a good one. They slice the mortgage payments into different layers or tranches, each with a different level of risk. Think of that flooding building.
The basement gets wet first.
Right. The lowest tranche, the basement, absorbed the first hit from prepayments or defaults. So to compensate for that higher risk, investors got a higher interest rate.
And then the higher floors, the safer tranches, they got hit later, so lower risk, lower return, creating options for different appetites.
Precisely. The top floor was the safest, lowest return, last in line for trouble. This whole tranching system was really key to opening up the market.
Okay, so into this evolving landscape steps Steve Eisman. The source calls him peculiar. What set him apart?
Well, Eisman wasn't your typical Wall Street guy. He had this inherent skepticism, digging into things others took for granted. He got really fixated on a company called Household Finance Corporation.
And their lending wasn't quite as advertised, was it? It looked like 30-year loans, but...
Yeah. But functionally, they were more like 15-year loans mathematically stretched over 30 years. So the advertised rate might be, say, 7%, but the real effective rate was closer to like 12.5%. Pretty sneaky.
Wow. That's a big difference. And Eisman didn't just, write a report. He was quite proactive.
Very. Talked to journalists, engaged with Acorn, that community group, which was pretty unusual for a hedge fund manager then.
Yeah.
He even went after the Washington State Attorney General about their investigation into Household.
He was blunt, wasn't he? Didn't he ask why they weren't just arrested?
He did. Why don't you arrest these people? And the AG's response was basically that Household was too big a player in the state's subprime market to just shut down.
Which Eisman pushed back on, saying someone else would fill the gap. Shows the systemic thinking early on.
Exactly. And it's interesting, the source contrasts him with Herb Sandler at Golden West. Sandler also saw exploitation, but in things like free checking accounts hitting the poor with overdraft fees. Different angle, same theme.
And Eisman had this broader realization, too, about the stock market versus the bond market.
Yeah, pretty early on, running his own fund, he saw that stock performance was becoming really tied to the bond market, especially mortgage bonds. He basically said the bond market was where the real action was, dwarfing the stock market.
And the leaders of these big Wall Street firms often came from that bond trading world, right?
That's a key point the source makes. Fold at Lehman, Mack at Morgan Stanley, Kane at Bear Stearns, they all had bond trading backgrounds. It really shows you where the power and maybe the focus lay within those banks.
Okay, let's switch gears to Mike Burry. Another contrarian figure, but with a very specific strategy.
Absolutely. While everyone else was riding the subprime wave, Burry saw the instability. He decided to bet against it using credit default swaps, or CDS.
Which is basically like buying insurance on these bonds defaulting.
Exactly. He paid a premium, betting that specific tranches of these subprime mortgage bonds would fail. If they did, he'd profit.
And his own investors weren't immediately convinced, but others started getting interested.
Yeah, initially there was skepticism, but as time went on, even other hedge funds started looking closely at what Burry's fund, Scion, was doing. People were curious about his reasoning.
Which leads us into the slightly mind-bending world of synthetic CDOs. What were these things?
Okay, so when Burry bought CDS on, say, a Long Beach savings bond from Goldman Sachs, Goldman could then create a new financial product. This synthetic bond mirrored the risk of the original bond.
But without any actual mortgages behind it, just based on the bet.
Precisely. It was a derivative based purely on the bet that the original bond would fail. Goldman didn't need more actual homeowners taking out loans to create more of these synthetic bonds.
So they could just keep creating more and more risk, basically untethered from the real-world housing market.
That's the dangerous part. To make, say, $1 billion of synthetic BBB-rated bonds, they just needed someone like Burry to pick a few hundred real BBB bonds and buy insurance, CDS, on them. Then they packaged that bet.
And then they took this package of bets to the rating agencies, Moody's and S&P.
Yep. And here's where it gets really concerning. The source suggests the agencies didn't really have their own robust models for these synthetics.
So the banks gave them their own models.
Pretty much. They'd say, here's our model, what rating does this get? And incredibly, about 80% of the tranches in these synthetic CDOs, which were based on risky BBB-rated bonds, got rated AAA.
AAA. The highest rating, like government bonds. That's just broken.
It points to a massive failure in the rating process. And because they were synthetic, the volume of these bets could explode way beyond the actual amount of subprime debt out there. The risk just multiplied.
And AIG got heavily involved on the other side, selling the insurance.
Massively. AIG sold huge amounts of CDS to Goldman, basically guaranteeing these bonds wouldn't fail. Goldman was paying AIG premiums, but the source mentions Goldman made something like $400 million a year just from the structure of these deals with AIG, seemingly risk-free for Goldman at the time. AIG was collecting premiums on stuff rated AAA, thinking it was safe.
So, while Burry and a few others were making these bets against the market, people like Greg Lippmann at Deutsche Bank, who was also bearish, had a hard time convincing others, right?
Oh yeah. Lippmann faced the classic, if it's such a great deal, why are you selling it to me? But also, investors didn't want to pay premiums month after month waiting for defaults.
And the complexity didn't help. CDOs are confusing.
Exactly. Plus, people just defaulted to trusting the AAA ratings from Moody's and S&P. Why question the experts, right?
And weirdly, the cost of this insurance, the CDS, was actually getting cheaper for a while, even as the underlying mortgages got worse.
Paradoxically, yes. It made Lippmann's bearish case even harder to sell. In the end, he struck a deal with Deutsche Bank. He could keep his short position if he actively built a market for these swaps, basically finding people to take the other side.
Okay, now let's bring in Cornwall Capital. A smaller outfit, different approach.
Right. Charlie Ledley, Ben Hockett, Jamie Mai. Their whole philosophy was looking for bets where Wall Street mispriced the odds of something big happening. Low probability, potentially massive payoff.
And Ledley's reaction to Lippmann's pitch was basically disbelief.
Total disbelief. It sounded too crazy, too good to be true. And these guys knew almost nothing about mortgage bonds or real estate. They were completely lost with the jargon.
Total outsiders.
Definitely not Deutsche Bank's usual clients. But they did grasp the core idea of the CDS.
How did they see it?
As cheap options, essentially. A small premium for a potentially huge payout if the seemingly unlikely event mass defaults actually happened. It fit perfectly with their strategy of finding mispriced risk and leverage.
And they got into the game relatively late, which actually helped them.
Yeah, coming in later meant they could piggyback on the analysis guys like Burry and Eisman had already done. They didn't have to reinvent the wheel. They could just absorb the arguments and act.
And they had this clear view of CDOs. Even if parts were rated high, if it was built on BBB subprime stuff, the whole thing was vulnerable.
That was key. They saw that a relatively small loss in the underlying mortgages could ripple up and wipe out even the supposedly safe tranches of a CDO if it was built on that shaky foundation. Many bigger players missed that.
The lack of transparency you mentioned earlier seems critical here. It was hard to even know what was in these CDOs.
Incredibly hard. Even the rating agencies basically admitted they didn't always know. Charlie Ledley calling S&P and getting told, oh, we're looking into that for a specific CDO.
Tells you everything you need to know. Billions traded without basic due diligence.
Exactly. Cornwall tried using data firms like Intex, but as a small firm, they didn't get much attention. They eventually found data on, of all places, a Lehman Brothers website, Lehman Live.
Resourceful. And that interaction with Bert Handler, who couldn't initially fault their trades?
Yeah, Handler couldn't really articulate why their short positions were bad, and later apparently admitted they'd made great picks. It just shows the level of confusion even among insiders.
Charlie Ledley was smart about how he approached insiders too, wasn't he? Trying to get to the substance before they dismissed his small firm.
Yeah, jump right into the analysis before the, wait, who are you guys? Questions started, which they inevitably did. Why are you here? Was apparently a common reaction.
And the justifications from insiders about why subprime CDOs were safe seem so flimsy now, like the roulette wheel analogy the source uses.
Totally. CDO buyers will never disappear.
Yeah.
Or relying on the very short history of low subprime defaults. It's like saying red has to come up because black hit 5 times. Just flawed thinking, driven by the profits being made.
Then the first real cracks started showing. The ABX index dropping.
Right. That index tracking subprime bonds took a significant hit. That was a clear signal. And it created tension within banks like Morgan Stanley and Deutsche Bank. Some traders saw the writing on the wall. Others didn't want to believe it.
And Morgan Stanley suddenly got reluctant to sell more insurance on this stuff.
That was a big tell. Suggested an internal shift, a realization the risk was getting too high.
But Cornwall kept buying.
They did. They saw the disconnect widening between the perceived risk and the reality and went looking for more insurance from places like Wachovia and Bear Stearns, trying to maximize their position before the whole thing blew.
Then, early June 2007, things really started to unravel. And firms like Eisman's Front Point started seeing big profits.
Yeah, the subprime market decline accelerated, and those short positions paid off. Eisman famously asked, "I know I'm making money, so who's losing money?" A simple but profound question.
And they expanded their shorts beyond just the bonds.
Oh yeah, they were shorting the mortgage originators, the home builders, even the rating agencies themselves. Their focus started shifting towards the big Wall Street investment banks, anticipating their securitization businesses would crumble.
Eisman seemed unfazed by going from, respected analyst to almost a pariah. It just strengthened his conviction.
Absolutely. The criticism didn't shake him. He pointed to the facts. Major lenders failing, projections of millions of foreclosures, soaring failure rates on recent mortgages. The data was alarming.
And the data from specific bond pools, like that OMLT 2005-3 the source mentions, was brutal.
Just devastating. You see delinquencies, foreclosures rising steadily early in 07, then these huge jumps in June, July, August. By year-end, defaults were nearing 38% in that pool.
Enough to wipe out way more than just the riskiest tranches.
Absolutely. Enough to hit even supposedly safer bonds hard. Burry suspected the Wall Street firms knew this was happening sooner because they owned the mortgage servicers handling the payments. They saw the data first.
Inside the banks, though, there was still denial or confusion, like Howie Hubler at Morgan Stanley trusting the ratings.
Yeah. Hubler seemed to trust the ratings even as the evidence mounted. And there were big internal fights, like at Morgan Stanley over paying out the hundreds of millions Lipman's trades had made. Deutsche Bank, while maybe more realistic, was still shocked by the sheer size of the money Morgan Stanley owed them.
And for Cornwall Capital, August 07 was when it all came together. The value of their CDS just exploded.
Completely. As big banks like UBS started frantically trying to figure out the value, or lack thereof, of their own CDO holdings, the demand for insurance the CDS Cornwall held just went through the roof.
A bidding war for their positions.
Intense bidding. Wall Street firms were desperate to hedge their exposure. Cornwall, the small outsider firm, suddenly held incredibly valuable assets, massive returns on their initial bet.
Mike Burry, meanwhile, got his vindication, huge profits, but wasn't exactly celebrating.
No. His fund returned over 100% that quarter, profits over $720 million by year-end on less than $550 million invested. But he said, making money wasn't like anything I thought it would be. He seemed disillusioned.
And he returned capital to an early investor, Gotham Capital. Shows a real shift in his perspective.
It does. Suggests the wind felt hollow, maybe even tainted by the scale of the collapse he foresaw.
Then Lehman Brothers collapsing in September 08 just lit the fuse for the wider market panic.
That was the tipping point. Despite Fed and Treasury reassurances, the Reserve Primary Fund breaking the buck because of Lehman debt, that froze the money markets.
Critical plumbing of the financial system seized up.
Exactly. Short-term rates spiked. The Dow tanked. Things got so bad, the UK considered banning short selling. Just sheer panic everywhere.
Even after all that, Burry stayed contrarian, started buying stocks in October 08.
Yeah, he figured massive government intervention would eventually lead to inflation and a stock rebound. But his biggest remaining investor immediately pushed back. threatening to pull their money, still going against the herd.
So reflecting on it all, the source suggests this wasn't just a one-off event, but rooted in deeper issues in U.S. finance culture.
Very much so. It argues the seeds were sown back in the 80s, with the first mortgage derivatives in 86, mezzanine CDOs in 87. It was an evolution.
That Salomon Brothers analogy about derivatives being like, guns the tool isn't the problem, it's the user.
Right. And the first mortgage-backed CDO came in 2000 from Credit Suisse, created by someone from the old Salomon mortgage desk. There's a lineage there.
And the line between investing and gambling got very blurry.
The source defines good investing as betting with the odds in your favor. The sellers of subprime, the originators, the securitizers, they arguably were. Most buyers, relying on flawed ratings, were not.
Yet, strangely, almost everyone involved on both sides got rich. Like Lippmann's huge payout in '07.
That's the paradox. Lippmann made a fortune even as the crisis he bet on was unfolding. It points to the incentive structures.
Especially the shift from private partnerships to public companies on Wall Street, encouraging more risk.
Definitely. Public companies, focused on quarterly earnings, embraced huge leverage, like 35.1. Private partnerships, where partners' own capital is at risk, likely wouldn't have pushed things so far, wouldn't have exploited rating agencies, or sold such toxic stuff to clients in the same way.
And the government bailouts, like for Citigroup, saved the system, but maybe didn't demand enough fundamental change in return.
That's the critique. Massive support, massive guarantees, but maybe not enough strings attached regarding reforms. And the interconnectedness through CDS meant one failure, like Citi, could trigger countless side bets, turning banks into these giant speculative objects themselves.
So wrapping this deep dive up, what Michael Lewis's account really shows us is this, well, incredibly complex tangle, misaligned incentives, flawed ideas treated as fact.
And a few people who somehow saw through it all.
We hit on some surprising things: synthetic CDOs amplifying risk, the rating agencies basically using the bank's own homework. These moments really show the strangeness of it all.
Yeah, the sheer complexity and maybe the systemic blindness that developed.
Which leads us to the final thought for you listening. Given everything we've talked about, the incentives, the structures, the complexity, what real safeguards are actually in place now to stop something similar?
Are there still blind spots? And maybe the biggest question, how does human psychology, greed and fear, still play into how these financial instruments evolve and behave?
Something to definitely chew on. We'd love to hear what you think.